Hi, I am Sachin Trivedi. I am the head of equity research at UTI and I am the fund manager for UTI Balanced Advantage Fund. The most important common challenge which the investors face is how they handle the emotional biases, right? The legendary investor Mr. Warren Buffett has said once, be fearful when others are greedy and be greedy when others are fearful. Now this is easier said than done. Maybe he has mastered this art of managing his emotions, and which is where he is successful. But not all investors can handle this emotional biases. So a study done by Morningstar suggests that because of this behavioral biases which the investors have, they have potentially lost 2.8% in last 10 years. To put it simply, if investor has put 1 crore 10 years back, he has lost somewhere around 71 lakh rupees because of this emotional biases that he runs. The other thing which we need to keep in mind is that not all investors can handle this volatility in the equity markets. Like we discussed, not all investors can handle this high volatility in the equity market, but there is a desire for investors to generate reasonable return, which is where combination of debt and equity kicks in. Equity, which gives you higher potential return, but at the same time it comes with higher volatility. At the same time, debt, which generates lower return but also comes with lower volatility. And these two asset classes have low correlation or negative correlation. If one can manage this dynamic asset allocation between these two asset classes, there is a potential for the investors to generate reasonable return with much lower volatility. But it is difficult for individuals to do it on regular basis on their own. Therefore, we need a scheme which is professionally managed and undertakes asset allocation in disciplined way. It is better that the asset allocation strategy is driven by fundamental approach and eliminates any of these behavioral biases. More importantly, it has to be tax efficient as well. So UTI Balanced Advantage Fund is a model guided asset allocation strategy that dynamically manages allocation between equity and fixed income and aims to deliver risk adjusted returns across market cycle to help investors achieve their financial goals over medium to long term. This way the fund brings three elements together, and you can say these are 3 Ds: diversification, dynamic and discipline. Diversification of asset, basically, which is the equity and fixed income. Dynamic, because we are dynamically managing asset allocation between these two asset classes. And discipline, because this asset allocation is guided by model based approach. So UTI Balanced Advantage Fund takes into input 4 fundamental factors. These are 1 year forward price to earning ratio. Higher the price to earning ratio, lower should be equity allocation. Then the other ratio is trailing 12-month price to book ratio. Again, higher the price to book ratio, lower should be equity allocation. The third factor is trailing 12-month dividend yield. Again, here, higher the dividend yield, higher should be equity allocation. The fourth factor is yield gap. Yield gap is the difference between equity yield and bond yield, and here bond yield we take 10-year G-Sec yield. Now, like I said, all these 4 factors are fundamental driven and make intuitive sense to us. So we have backtested the model, and model has generated an alpha of 2.1% over its benchmark since January of 2012, considering only the passive outcomes of Nifty 50 TRI and Nifty Composite Debt Index. One leg of alpha creation for the fund is taken care by in-house proprietary asset allocation model, which determines the asset allocation for the fund. The next primary source of alpha creation in the fund is sector selection and stock selection. The sector selection can contribute to the alpha. Hence, the fund will take active call in the sector and may have overweight and underweight position in the sectors. When it comes to security selection, fund will follow blend style of portfolio construction. The fund will have flexibility to invest in stocks which have long runway for growth and also participate in cyclical opportunities that are available below their intrinsic value. including turnaround companies that are currently undervalued. We have consciously chosen a blend approach as we feel it is better suited to the objective of this strategy. The portfolio will be large cap bias. The role of fixed income in the portfolio is primarily to bring portfolio stability. The focus will be on quality and liquidity in the portfolio with investment in sovereign, AAA and equivalent rated papers predominantly. While net long in equity in the portfolio will be 30 to 90% as determined by the model, fixed income allocation will be in the range of 10 to 35%. The fund will invest in arbitrage to maintain gross equity exposure of more than or equal to 65% to provide equity taxation benefit. Well, we saw how investors' returns are compromised because of the behavioral gap. Therefore, there is a need of asset allocation to manage market volatility, but it is difficult for most of the investors to regularly rebalance portfolio with the changing market dynamics. Therefore, UTI Balance Advantage Fund, which dynamically manages asset allocation based on model-driven approach, can help the investors overcome these biases and challenges of the portfolio rebalancing. Investors looking for reasonable return with lesser volatility can look to participate in this fund through lump sum or SIP. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.